Hello everybody, welcome back to my channel where we talk all things finance and investing. In today's video, I'm going to highlight three of the most popular exchange traded funds, ETFs as they're known as, for UK ISA accounts now in 2025. We'll get into all the details, the charges, the pros and cons of them, and what they actually track underneath in the ETF itself. So yeah, on that note, let's get into it. Okay, so before we get into the actual three ETFs, a couple of reasons why these ones are so popular, okay? And the number one most obvious reason is all three of these ETFs actually trade on the London Stock Exchange. They're also all denominated in pounds. And of course, ISA accounts are required to be denominated in pounds. You can't have an ISA account in USD, for example. So therefore, you avoid any foreign exchange conversion fees. So that makes them more cost effective for you. And of course, they're all ISA eligible, and they're also eligible for SIPPs as well, which is a self-invested personal pension. And last but not least, these three funds are managed by some of the biggest names in the actual fund management. So you can take some comfort that you're investing with a big, well-known provider of ETFs. Before we get into it, I thought I'd just give a very quick definition of an exchange traded fund or an ETF in case you've not watched any of my videos before or you're just unaware. But an ETF, an exchange traded fund, it's really just a fund, a pool of money that investors like you and I will put into a fund, and the fund manager will go and then buy individual stocks that's in line with sort of the mandate or the agenda of that particular fund. Okay, the benefit to you is it's a pooled asset and you only need to do one transaction on the stock exchange rather than having to do all the investment research and time and everything to buy your own stocks, which takes forever, and frankly most individual investors have very poor results. So ETFs have become very popular because one transaction you can buy in, and for the most part ETFs will just track an underlying index, so you actually get the full market's return rather than taking the risk of buying individual companies in the stock market. If you're new to investing, even if you're a seasoned investor, really, I think ETFs are really a great way for you to go. Okay, so on that note, now we know what ETFs are, let's pull up the table that I've done up here with the top three ETFs held in UK ISAs in 2025. All right, so the first ETF that we're going to look at today, one that's extremely popular, maybe the biggest one, and that's ticker symbol VUSA. Okay, and that tracks the index of the S&P 500, the 500 largest companies in the US, the most obvious ones being the big ones at the top, Microsoft, Apple, Amazon, and companies like that. It came to market in 2012, and it's actually had a 10-year compound annual growth rate of 14.9%, which is absolutely fantastic. Really, when you think about it, for the last 10 years. If you go back to inception, the compound annual growth rate was around 13.65%. Very, very stellar indeed. To put that in perspective, if you invested £10,000 in this ETF 10 years ago, today it would be worth around £39,000. Think about that for a second. You've basically quadrupled your money in a 10-year period just by getting invested into this ETF and letting those companies in the stock market do its thing. Unbelievable returns, really, when you think about it. There's no guarantee that that continues. Nobody really knows. But those are some pretty solid numbers over the last 10 years and really since inception. The ongoing charges, and this is how, if you invest in an ETF, the fund manager needs to take a fee of all the assets and the funds that are invested into that ETF, and it's usually done on an annual basis, and it's usually just done in the actual price of the fund itself. But the fee is actually 0.07%. This makes it one of the cheapest equity tracker ETFs that you will find on the London Stock Exchange. The dividend yield for it is 1.5%, and you can choose a distributing fund where the actual dividend gets paid into your account, or an accumulation fund where it actually gets reinvested into the fund itself. So the choice is yours. The main feature of this really, and the main benefit, is this is going to give you low cost exposure to the US stock market, which has been humming along really for the last 20, 30, 40 years, very strongly, mainly due to technology. All right, ETF number 2 on our list, ticker SWDA. And what this one is, it's an MSCI World developed markets. So what does that mean? Generally, when you talk finance and investment markets around the world, global funds and whatnot, they tend to be broken down into two types, developed and emerging. And developed markets are really places like UK, US, Canada, Australia, most of Europe, and a few others maybe like Japan, for example. And these economies are very mature. They've been going for a long time. They don't tend to grow quite so fast as emerging economies, but they're up and running, and they tend to be pretty safe places to invest your money. Emerging markets are kind of the opposite. These are countries that are getting up to speed. They tend to grow very fast, but that growth can really fluctuate as well. And they're just generally considered a little bit riskier places to invest. They've got a lot more exposure to things like the US dollar and how strong or weak are the movements that happen in that as well. Okay, but this fund, the SWDA, invests purely in developed markets around the world. Its inception year was way back in 2009, and the 10-year compound annual growth rate was 12%. Its compound annual growth rate going back all the way to inception in 2009 has been 11%. And to put that in perspective, £10,000 invested into this fund 10 years ago would be worth £31,059. So you basically tripled your money. Again, not bad going for a 10-year period. It's a little bit more expensive because obviously the fund manager needs to go out and buy companies around the world in these developed markets. It's not just the US, it will be spread out, and sometimes that can be more expensive. So therefore, the ongoing charge is at 0.2% per year. The dividend yield is a bit higher, and the reason for that is because there's kind of less tech companies. You're getting more exposure to other big name brands in Europe and Asia, for example. They tend to pay a little bit of a higher dividend. So the dividend yield right now is around 1.9% on that one. The kind of main feature of this one is you're going to get a broad diversification across developed markets around the world. Think about all the big names, not just in the US, but throughout Europe and Japan and others as well. Finally, we have an ETF for the FTSE All World Global and Emerging Markets, okay? So this one has a bit of both, developed and emerging markets, ticker VWRL. It's a Vanguard FTSE All World Fund. The inception year on this one was 2012. The compound annual growth rate over the last 10 years was 11%, the lowest of the three, but still very, very solid indeed. But if you look at its compound annual growth rate back to inception in 2012, it's actually been at 14.89%, which is very, very good. Okay, and £10,000 invested in that 10 years ago would give you £28,000. A little over that just now. So again, you've almost tripled your money. But the fees are a bit higher, again, because the fund manager now needs to go into more markets to buy the shares of not just developed, but emerging markets as well. So it's a little bit more expensive at 0.22%. But the dividend yield, again, is higher, 2.3%. So that might be something you're going to look at if you're somebody who prioritizes dividends, which in all honesty, I don't think you should do. I think you should prioritize capital gains, but that's just my opinion. The key feature on this one really is you have one fund that basically owns the world. And by owning the world, we really mean all of the developed markets and a lot of the emerging markets as well. So if you just want to ultimately set it and forget it and have a very passive strategy where you invest in this for your ISA account and have a broad diversification across the globe, then this may be the ETF for you. So which one of these should you choose? Well, it's really up to you. And the honest answer is you could do a little bit of all three. But my advice to you really is just to keep things uber simple and not to overcomplicate it. The main thing is that you get invested. Year to date, we've seen the European markets outperform the US, for example, but nobody knows what the future holds. So when you make your decisions, you really want to think about what the next 10 years look like. You don't want to think about what the next 1 to 2 years look like because frankly, nobody really truly knows. But if you just want a good slice of the US and mainly the tech industry there, then VUSA is a pretty good one to go with. But if you just want to diversify across all developed and emerging markets, then you can look at one of the other two ETFs that we mentioned. Frankly, when we've seen with the compound annual returns, you can't really go wrong with any of these three. Of course, you want to make sure that you do your investment inside an ISA, an individual savings account, to take advantage of the fact that there's no capital gains tax, no dividend tax, or anything like that. You also want to make sure that you do an automatic investment program. So money automatically comes out of your bank account, goes into your ISA account, and then gets invested into the ETF that you ultimately choose. Always recommend that you read all of the fact sheets, all of the information on the ETF before you decide to make an investment decision. It is absolutely critical that you do this and you do it and understand this for yourself. And of course, once you've decided you've got your automatic investment going, make sure you instruct your broker, your investment platform, to automatic reinvest any dividends that come in. This will be a big part of those returns that I mentioned earlier. So don't forget to do this. Automatic reinvest your dividends. So that's my video on 3 of the most popular ETFs right now, 2025, in UK ISA accounts. If you're watching this from outside the UK, no problem. Have a look in your country and there'll be similar funds to the ones I mentioned that probably trade in your local stock exchange as well. But let me know what you think. Are any of these things that you would invest in? What do you invest in your ISA account now? Do you do individual stocks? If you like the video, then please click on the like button. And of course, if you haven't subscribed, a lot of my viewers are not subscribed to my channel. Please click that subscribe button. I'd really appreciate that. It helps me grow up my channel and continue to make more content like this. If you're wondering what's in my portfolio, well, I'll gladly share that with you because I did a video on this a couple of months ago called my One Fund Portfolio. Put a link to that right up here. You can click on that one. I'll see you over there. And as always, I wish you all the best in your savings and investment journey.